Were you surprised, as many in the market were, by the dovish tone of that statement from the RBA yesterday? And when do you see wages growth meeting their threshold for tightening to begin?
We weren't particularly surprised. I mean, going into the meeting, we were expecting the RBA to remain dovish. And as you mentioned, it's largely due to the wages outlook. So we think wages are one of the key areas that the RBA is going to continue to look at. And we hadn't had enough evidence of wages picking up in order for the RBA to be confident that inflation would remain sustainably around its 1 to 3% target range. So we still think there's more room to come. And there were a few signals from the RBA's policy statement that just suggest it's really still not going to be in a rush. Firstly, it did mention that the end of QE, which was announced, did not necessarily mean that RBA hikes were imminent. So that suggests they are still going to remain patient. And patient was a key word that we saw in the statement as well. So we think that we'll start to see wages growth picking up, and that will be in line with a RBA rate hike in August.
Well, just as interesting as what was in the statement was what wasn't in the statement. There was no guidance at all around changing when tightening might begin, but we just saw on a chart there before that the market does still anticipate the RBA raising rates in the second half of this year. So we've seen the market force the RBA's hand before when it came to abandoning yield curve control. What are the chances, do you think, we'll see it again in terms of when rate increases begin?
Look, we do think that rate increases are going to happen before the RBA is currently, well, the RBA's current guidance suggests. So our forecast for a lift-off in August is definitely earlier than the RBA is obviously thinking about currently, but we are expecting to see some more higher CPI prints. We're expecting the labour market to tighten further, and we're expecting that to flow through to wages growth all earlier than the RBA is expecting. I think one thing that will be interesting to see is that we didn't have any preview of the RBA wages forecasts in the statement yesterday. So we will be looking to see what the RBA is forecasting in terms of wages growth when it releases the statement of monetary policy on Friday.
Kim, bottom line, it seems that so far at least, the RBA remains a little bit more dovish than the Federal Reserve, right? So when you have this slight divergence happening, where does the Aussie dollar go from here?
In our view, the Aussie dollar is still, the risks are still skewed to a slight depreciation. So we do think Aussie could dip back below 70 cents in the near term. And as you said, that's just a reflection of the divergence in policy outlooks at the moment. The FOMC has basically announced that it will start raising the Fed funds rate in March at the same time as it wraps up QE. I mean, that's in line with our view. So that divergence is a near-term headwind to Aussie, but not a medium-term headwind, because when the FOMC is starting to raise rates, that's really a positive sign for the global economic outlook, and therefore that tends to be positive for the Aussie dollar.
We haven't seen that much support for the dollar lately, though, right? We are talking about, what, the largest decline in 2 months just on Monday for the greenback, and it seems that the gain in 2-year yields haven't necessarily translated to dollar strength. So just zooming out, where is the greenback going from here?
Yeah, it's been quite interesting. And I think one thing that we've been looking at quite closely is how the USD actually tends to react when the FOMC starts tightening. Obviously, FOMC tightening cycles are a big event for financial markets, and we actually see that the USD tends to fall when it starts tightening. And that, again, is just reflected in the fact that when the US economy is at a point where the FOMC needs to tighten, that bodes well for the global economic outlook, and that tends to be a weight on the USD, which is a counter-cyclical currency. There's a little bit of risk that we still see some near-term volatility, just if equity markets step lower again. But if we see a stabilisation in equity markets, we do still think that the outlook for the USD over this year is for it to weaken.
Kim, we also have an ECB meeting this week. What are your expectations around that and the direction of the euro?
Look, we think the ECB will just leave rates on hold and retain this dovish view that it's had for quite some time. So the ECB is still very much expecting inflation to be transitory, We've seen Christine Lagarde at pains to point out that inflation is a lot weaker in the Eurozone than it is in other countries such as the US. Therefore, what we're seeing in the US doesn't necessarily translate to what we would see in the Eurozone in terms of monetary policy outlooks. So, if we do see that dovishness continue, that's just going to remain a headwind for the euro. And we could see a little bit of near-term weakening in the euro if the ECB does just hold strong to that dovish rhetoric.